Good afternoon, welcome. My name's Jeff Nightingale. I'm about to run you through a presentation on Forecast 5, as a reminder tells me, which is good. Okay, thank you for coming along and let's walk through it. So the product Forecast 5 is a purpose-built budgeting forecasting solution. So its primary purpose is to remove what predominantly is the pain that goes with preparing Excel spreadsheets. By what we've done is automated a lot of the calculation processes and then extended a lot of the functionality. So as a base output, we produce 4 core reports: profit and loss, balance sheet, funds flow, and a cash flow report. We handle just about any combination of information, and we'll go through a few of these: wages, stock, sales, accruals, prepayments, that sort of stuff, as well as the balance sheet, depreciation, fixed asset acquisition, capital expenditure, loan repayments, amongst other things. Beyond that, you can then extend the forecast into up to 15 years. I have seen longer, but we haven't even worked on anything deliberately to do more than 15 years. So I have seen a 50-year forecast. And then you can record actuals. Some of the key features beyond that is consolidations of multiple departments, and equally the import and integration to financials. So what we're currently looking at is our login screen. So from this login, I've already logged in. I have a list of forecasts that I have available to me, and I can open any one of those and proceed into those. But what I'm going to do is just make out a small case that we are just needing to do a budget for a client or ourselves. We're going to pull it from Xero, and because I want to start with last year's information, I'm going to go back to April 2023 and select that year and go OK. What this will now do will generate a blank forecast template. So we'll just have a look at that for a minute or two on that. So while we're going through this, feel free to put any questions into the chat box, and I will do what I can to address them as we go. Bring in that. Okay, so what we'll do is we'll call this the April 23rd demo. Okay, now what you're looking at is our standard default layout. So sales section, cost section, overheads, depreciation, other income, extraordinary items. So that's our profit and loss layout. These are what we call sections, and you can create as many sections as you need to reflect. Within a section, we add folders, and those folders can go down multiple levels to 5 levels. So you'd get a drift down like that. And at the base level, we budget by records. So this one I'm going to do is I'm going to start by pulling it in from Xero. So we'll just go and connect to Xero. And we'll go into this. So I'm just on the other screen following the login process into Xero over here. And it's telling me I want to access a certain organization. So we'll pick on my body corporate. We'll allow access. This is a precinct, right? And I've now been allowed access. So what we can now do is get the tokens, get the tenants, and select harvest height and go OK. So the first structure is we've now connected to it. So up here we've got connected. Secondly, we recognize and import the tracking categories out of Xero. So each tracking category combination will create another record based on the account code. So a sales GL code plus 1 tracking category will take 2 records, because there's a blank one and a blank plus 1 category. There's 2 categories, it's 3 records. So whatever you do there. Now, if inside the tracking category you have 10 in each of them, that's 100 combinations, to be aware of that. We also included the import of archived accounts and all accounts, but I'm just going to quickly go into import data. Probably should have done that before I started talking, because this is now going back to Xero. It is totaling up all the records to get us a monthly figures, because Xero doesn't hold the data in monthly figures. And it's going to present to me this list now. That's why I pick on a small body corporate. So these are the GL codes. It's recognized sales go in the sales section. We don't have any direct costs. We've got bank fees, consulting, depreciation. I'm going to map that to the fixed asset, which is down the bottom there, which is called the camera. So that's a nice little trick. So the depreciation record type is now linked to the fixed asset, and it will be treated as non-cash, an important advantage. Our salaries, which are none in this entity, but they're wages, so we'll just type them up as wages. Now, all of these can be done later. It doesn't have to be done now, but just for simplicity, I'm just going to map the main bank account. So the Westpac check account, and we do not need to import that because we've got it mapped here. We're going to link the fixed asset to the depreciation, So let me see, I've got the right one. The accumulated depreciation asset, and that's there. The logic why it's upside down has something to do with that. Now, some of these records, we're not going to import the GST, the debtors, or the creditors, because we in Forecast 5 have forecast records, which are GST, debtors, and creditors. Equally, income tax, we're not going to import. PAYE, it doesn't have, but we'll just put it down there because we come down to here and say, right, our retained earnings is going to map our capital, which there is none's going to map. So a little bit of bear with me here while we get back. Now, I'm now going to link the GST Forecast 5 record to the GST code. I'm going to link it to accounts payable and ditto for accounts receivable. Right, the capital, we'll just link in the reserves. We've got capital account. I don't think there's anything in there. Retained earnings, I can type the name and get a drop sort to that level or jump to that level. PAYE, select that. And I think I did income tax as well. So I'll leave it at that this mapping can be saved. This is a once off. It's done once and that's it. So we just simply go there. So the import data routine will now bring in the GL codes and the calculated balances starting from the 1st of April 2023. Considering today's April the 23rd, it's getting a little bit of a tongue twister. Okay, so that takes a little bit of time to bring that in there. The advantage of this now, once integrated, I can bring in my opening balance sheet. I can bring in my month-by-month actuals. So it becomes a very strong and simple process of bringing on and providing ongoing management information, management reporting on a month-by-month basis against the budget together when we're in actuals, allowing us to do rolling budgets. So yes, it's been done. So that's going to toss me back to the list. And I'll reopen this again so that we get synchronized. So now we've got body corporate levy. We've got all these records have been imported with values. Now, let's look at the record. The record name, description that was imported, so we know where it came from. Record type. We support 3 types of income records. So we'll go into something like an accrued and prepaid income. So let's take the other revenue just for an example. And we'll just do it as a prepayment. So what that means in accounting terms, as we all know, it's an accrued and prepaid record. We have a particular type. We make it a prepayment. We'll just budget $1,500 a month and we'll prepay it every 4 months starting in April. So there's my invoice going out. There's my balance sheet provision. And there's my P&L recognized as revenue. And we can see the cash flow coming in. So that's the type of information we are building as we create a forecast. So coming back to this first record, and then separately invoiced income record allows us to do a range of things like separate bank accounts, eliminating consolidations, eliminate and avoid it from factoring and various streams there. Now, the bank account that we're going to use, so if I come back to other revenue, and if I had multiple bank accounts, which I did, I could selectively bank or pay out of that bank account. So that's an option from here. Next, come back here, our currency and our GST. So those are the defaults. If we go into our settings, details, select our settings, and we can see here parameter defaults, our days credit, our input payments method, so we can change any of these settings, our straight line, our GST, our depreciation. If we go to GST rates, we can see 15% is GST. I can add in a different rate if we want Australia for some reason. We're going to do something in the Australian market. In this forecast, we can create 10% and we can change our basis and our payment. Equally with currencies, you can create as many new currencies as you need. USD, put in the dollar sign, put in an acronym for USD and put an exchange rate 0.65. Actually, don't really know, but month by month exchange rates, the same as GST month by month. Profiles, we'll create one. So we're just going to, in this budget, we're going to create some wages and we're going to pay them fortnightly. So what we want with the fortnightly profile is to recognize that most months have 2 payments and twice a year we have 3 payments. And we'll just put that in for July and Feb and January. So we've got our 26 periods. So that's a spread code. Equally, payroll tables, bonuses, pensions. So let's default the 3% KiwiSaver. So that becomes the default setting, and our PAYE is paid monthly. Okay, so that's just some of the settings we maintain, but once set, they've done. Walking through these, the general ledger code that sits in Xero, project code and external code will hold the tracking categories 1 and 2. Department code is an option that we added for a client, so everything we do is built into one single product. There is no streams of products, there's just one version. The full GL code is another field that we use. Now, these are all available via ODBC into Excel. So when you go into dashboarding and that within Excel, we can access these there to run the reports. What if multiplier, which is when we get to what if, and we'll show this a bit later, we can put the frequency, and then our daily cash flow calculator. This one's paid monthly on the first day of the month. And because it's set up to be 20 days afterwards, we'll get into that detail in a second, that would be the first day of the month after. If I show this now, show system data, it will take a little bit of load. It will tell me that the money is going to be banked on the first day of each month, including GST. So we have a bunch of data we suppress because it's not relevant to the process, but we use that in calculations. Okay, so let's move into a little bit down here. In here is our data entry for the record. So this is the monthly amounts that I've pulled out of Xero, and I could refine those or change those. And that, so that we support a whole range of methods. So manually entered, I can key this 9, like you'll start at the top, 9,333 a month. So that spreads the whole thing down there. I can go down here and put 120,000 in the month. I can hop over to Excel and I can do a few things with that. So we'll just come from here, we'll copy this to the clipboard. We'll open up Excel, we will want this as we go. Just when it gets synchronized, let's just say we'll go like this equals this times 1.5. Copy it along, copy that again, come back to here, select the box, paste from Excel, and I've updated that. So there's some really useful, simple ways of getting data back and forth. That's just on the manually entered. Profile, I'll show that as wages, calculate by units. So we sell by product price, $1,500, and we're going to sell 100 units a month. There's our extension straight away. Similarly, percentage of sales, costs, memos, and that. Now, sorry, wages. Now, memos, this is a little bit more entertaining. So memos is KPI budgets. So we allow, in our system, we have down here a section called memo records. If I wanted to show memo records, we could have number of rooms. So we've got 30 rooms. We add another memo. And we have a whole range of predefined memos. So days per period, we've got calendar months. So we're good to go days. We come up here, so we add another record, which is the occupancy percent. And we'll just go at 95% at this stage. I'll use it like that. And then our rack rate, 150 a day. Right. I can bring myself back up here, and I can from here or down in the memos, either one. Just before we do that, I'm just going to make sure that these memos print on my profit and loss after gross profit. Now, new record, accommodation. Give or take my spelling, typing, don't worry about that. I'll go to formula, or I could have gone percentage of memo. It could be calculated, and we could have 100. Click on the rate, 150%, boom, like that, or more commonly, formula. Exactly what you do in Excel, except for it's simplified, because what we do is we select our records, times, days, times. Now that's where I want to do. I want to do a bracket, percentage period divided by 100 to convert that 99, delete that one, and then we want to multiply all of that by the room rate. Right. So I've got a KPI base from it, and if we suddenly come down here and say our room rate's going up to 200, I've now immediately got a change in the accommodation down here. Right. Very simple. So this is the ways and methods that we have for creating numbers. We have various other options, stock on hand for things like that, and then hot link. So hot link is Really quite a valuable. If all else fails, we need another record. We'll just pop one in here. Yeah. So when we bring this in, that will automatically create it based on accrual. We'll go back to separately invoice. These options for data entry or methods exist in all of the records for P&L. So that's pretty straightforward. So, but the final one we were just going to demonstrate is what's called a hot link. So a hot link can be either another forecast or Excel. And so just to give you an idea what Excel and the power, we'll find something down here. We'll use that one. And it's got nothing in it. That was a good choice. Sorry. We'll go to the hot link again. We'll delete that one. We'll just add another one. We'll find something with some data in it. Should be this. Okay, so this is a report I've already done with no values in it. We'll just take something that's got a value. That doesn't really matter. So there's 81617. That's now linked to that spreadsheet. Update the spreadsheet, refresh the hot link, etc., etc. It's all updated. Excuse me. So that's sort of our profit and loss. And if I click on the sales section at any one stage, I can be presented the information that's in place, that's there, and I can equally drill down. And I can hop into the record and see that data and change it. So anything we want to do that. So let's just put a name on this one. Now, let's go our direct costs. So cost of goods sold, add a record. So the Harborside precinct doesn't have any, but let's just say we've got a stock record. Now, there is a presumed assumption around forecast 5 and a stock record. The assumption is there's a balance sheet value. So no matter what we're doing, we could have a percentage of sales from our body corporate levy, 50%, and that's easy. That's the cost of goods sold. But then we might say, click on that, 50%. Let me get back to that. Why is that not playing the game? It's probably just hasn't been initialized, so we just go utilities, budget record recalc. And these are the two routines that calculate the data for us. It takes a minute or so just to recheck every calculation, and we'll get that to trigger through here. Once that finishes, the system record recalc recalculates all of the records based on the calculations about the GST, debtors, creditors, etc. So that's just going to come up in a bit. So while we walk on there. So stock records have the balance sheet, and I'm also going to do in this particular part of the section display the day's credit functionality. And so that comes down to the payment side of every record. So within Forecast 5, every record can have its own payment terms. That's pretty difficult, isn't it? Right, that's better. That's triggered that one. All right, so it doesn't like the body corporate levy. I'll worry about that later. Now, here's my cost of goods sold. Whatever percentage we put in here, that will calculate automatically based on the sales. Now, over here is my stock. How am I adding or building my stock level? I can calculate a number of days on hand. So if we go 45 days, we'll get half a month or whatever number we want. But we equally can do it by closing stock or stock value. So my closing stock value, I target it to be $100,000. We will then calculate the demand to get the purchases to keep it at that value, etc. So we also can handle EOQs using batches. We buy in the batches of $65,000 worth, and we want a minimum stock level of 40,000. Actually, what we'll do is, let's say we just take this batch size up to 200,000. Probably more easier way to demonstrate it. You can see here we're only doing occasional purchases to map with our necessary, so the purchasing happening. Now, over here, and on all of the records, we've got our payments and receipts function. So at the moment, we're defaulted to day's credit. I can also select manually entered, right, which is obvious. We just manually enter. Or option number 2, most frequently used after day's credit, is payment profile. And what that means is I pay 50% of a deposit 90 days in advance, and I pay the balance on arrival, or the balance 30 days later. Or if I pop up to our body corporate levy, which is why I didn't get any revenue. So we lost our numbers here. We'll just pull that back, put in our 10,000. That's why a percentage of stock didn't work on that record. Just maybe that. Now we've got a little bit more. What I was showing here is we could also equally say we get paid 60% 30 days, 20%, no, start again, 60%, 20%, 15%, and then 5%. So we get a spread of the money and how it's coming in on this record, right? So that is the power of when you're into your payment management and your cash flow management. You can start to see there. So let's move down to two other records, or one other record type. So we've done stock. Let's deal with salaries. Right. So we have two records, gross wages and wages. One goes from wages down to PAYE, calculated as a percentage, 25%. We'll make this 15,000. Right. That's the simplistic method, or we can go from net wages plus PAYE. The most common method and budgeting method is employee groups. This is very powerful. And what we have done in here is, firstly, let's dictate that we're going to pay these fortnightly. Secondly, employee entry. So we could have Johnny, and there's one of him, and he's on 40 hours at $35 an hour. Now, straight away, it's calculated the gross, put him on KiwiSaver because I defaulted that, and calculated the PAYE that goes with it. Inside this, I can go into bonuses, commissions, formula, so I can link it to anything. Like if I wanted a formula to do a percentage of net profit, I could literally come in here, set up a memo, and therefore I would get that number brought through. And I don't like it as a negative because I really want to pay it, so we'll just negate the values through there. Right, so that's the sort of thing for formula. We can also calculate or budget a bonus of 10% in February, and that will uplift the wages by 10%. That's Johnny. I can now add teachers, grade 1. We've got 15 of them. They do a 37.5 hours. Oops, we better not put in the foreign figures, 37.5 hours. And they're on an annual salary of $85,000. So now we've got a max grossed up functionality that goes with this on each of them and working that through. And each year has its own rates, so we can go into each year. Each record has its own start and finish date. Okay. Obviously, I can create as many records as I need and as many. So, yes, I forgot one other little cute feature. Let's just go down to the teachers and let's just make it 3.5 full-time equivalents. Okay, so part-time staff can be handled. Okay, so that gets us down through the profit and loss areas. The depreciation section's a reserve section for our assets to go into, but you can create more sections and all that. Let's look at the bank account. The main bank account settings is an overdraft rate, 8%. There's a credit interest rate, 2%, and it calculates those interest rates, and similar to that, our reserves account, our sinking fund deposits, and our call accounts are there. Let's deal with fixed assets. Right, so I've got a camera. I have as yet not got any balances for the opening. So let's go back to the opening balance sheet. And because I'm linked, let's just import it as at. We won't yet. Well, we will do. We'll import it as at the end of March this year, the import. And it's obviously disconnected itself. Yes, when I exit, we are forced to disconnect by Xero. So let me just go back and reconnect. So you go straight through the process again. Settings, authenticate. Select the organization that's on my other screen. Sorry, so just don't need to go through that with you guys. Go to Xero, tokens, tenants, and Harborside Precinct, and now we're connected again. So the status shows up here all the time. We'll go back, and what we were doing was importing the opening balance sheet. So let's go back to March, because we want the opening balance sheet, i.e. the end of March 23. We'll import all of that. And we get all of the figures. Now, this is not likely to balance. I'll take that back. Gee, that's good. So the balance sheet balanced. All right. Normally it doesn't, because we've got loans and all that, and they require specific setup. So a loan must have terms and conditions. But that's great. That balanced. It's absolutely got all the right records. But it's very simple to dump this out to Excel, reconcile it to the balance sheet, or have a look like that and something there. So now I've got my fixed asset and I've got my depreciation. Every record has its own method. So diminishing value, 15% on the camera. And we know that we're going to buy some more stuff. So I'm going to buy another camera later this year. Camera number 2. And good old typing that I didn't do. I might lease this. So let's do it as a financed asset. So we do manual loans in here for lending organizations. We've got some processes around repayment of capitals and recycling the capital, but I'm going to have a new loan. We're going to do this in August. We're going to pay it off over 24 months. It's going to cost us $15,000 fully installed, wireless and all the stamps. We're paying 9% interest rate. Right now, you're seeing the benefit of automatic calculations of loans. So there's our loan payment. There's our depreciation being calculated, straight line 15%. And along here, when I spread this out or show the system data, we will see the interest calculations going along this as well. We can see that very quickly. And there, once that comes up, so we can have those being calculated. We can manage the methods, simple interest, compound interest, interest only, the payment frequencies, in arrears or in advance, deposits, bullets, balloons, holidays, and then disposal of that asset. But let's just leave that in there. We'll move down to the next thing. Factoring records. It's not commonly used in New Zealand, but it's the financing of your debtors ledger as they happen. So we support being able to factor debtors as a percentage and that, and we also support the factoring of stock. So the two main things you might run into frequently is shop floor financing. So we can select this to be debtors, stock, or separately invoiced records, percentage of trade debtors, that sort of thing, and you get all of this stuff coming in through there. Right. So that equally loans. We add loan records. We have two types of loan records, calculated and manually entered. So this is a calculated loan. We've already seen this type of record and this information that we accumulate, settled differently. Manually entered loan taken or manually entered loan made, two types, one's borrowing, one's lending. Just allows us to manually say, we've got $50,000 coming in, 40,000. Because it's zero, we couldn't pay it, so we'll receive the 40,000 first. Then we'll pay back $1,000 a month. Back down one there, we'll take away the first month because we didn't have anything. Put in an interest rate, so just calculate it. We go 5%. Boom. So we now have a loan manually calculating something like that. So one of the things I probably want to do is I just want to make a dent in our bank account. And so by doing that, I'm going to buy another asset. We'll just call it an ordinary fixed asset. So I'll push it into overdraft so we can see the cash flow calculations and all that working. So once we bring that across to just an ordinary asset, coming up now, plant, we're going to spend 250,000 here. We'll depreciate straight line. You can see the payment going out, the number of days and all that. We also handle disposal, gains and losses on sales, and write-offs. So writing off the asset value involves removing the depreciation component as well as the full asset component. Okay. Now, past all that stage, we end up with an area called other assets and liabilities, and that's where everything else can go in there. And there's just a significant list of options: other debtor, creditor, current asset, working capital, liability, working capital, manually entered loan taken. Right, all of that process. Okay, so we have there finally into our reserves and accounts, or the capital section. So we can create reserves, transferring from retained earnings or from capital, payments in and out. And so, for example, there, and then the other type of capital reserve is capital changes. So issue shares at a premium, twofold. One, you issue the shares at the share value, and then there's a premium, a reserve, share premium reserve created. Okay, so we've seen memos briefly, just to give you an idea of many of the other types of memos, which allows you to build a reporting process around your covenants, days per period, formula, sales units, cost units. Down in here, we get into the balance sheet, percentage of loan balance. percentage of bank balance, stock units added, other creditors, debtors due. All of these are available, and all of these can be printed on the profit and loss. We've got a couple of those coming through. Last couple of parts, adding an assumptions record. Sales assumption. Sales are calculated from last year's values. So you can incorporate inside your budgeting model your commentaries and all that. And there is a lot of text here. I gave up at about 8,000 litres one day. I just didn't see the need of getting too far, but we'll just leave that like that. Down the bottom, I mentioned this earlier, is called forecast records. A few of these need to be taken into account. So income tax provision, as a percentage of profit, 28%. Now, we haven't calculated anything for this forecast yet, so we haven't as yet got the calculation done, which is done when we go to either system record recal or reports, but we'll come back to that. So we might just digress over to there. I think if we do a system record calc here now, that'll give us some data to work from on some of these things, because obviously the next one we want to deal with is dividends. We've also got bad debts, obsolete stock, general provisions that are calculations against those figures. So you can plan obsolescence of your stock and your bad debts or doubtful debts in the core part of it. Bring that into play. So working through that, as I said earlier, if there's anything you want to ask, feel free to put it through the chat box and we'll see what we can do. Right. Right, now we've got our calculation for tax, and we might make our provisional whenever they're supposed to be, right? And we've got that calculation going on. Equally dividends, so what we're going to do is we're going to pay a dividend as a percentage of profit after tax, so we get rid of the imputation. 40% gets provided for. We'll pay out 170,000 and an interim of 100,000 in March. Now, right, so right now we've got a pretty comprehensive budget. Couple of things. Let's go back to the home thing. Let's build this for next year. So let's extend this forecast to 2 years. We will factor a 5% change in revenue, costs 3%, overheads 4%, and wages 5% as well. So we'll go okay. Now, I haven't run any reports on these yet, so we'll get to the whole picture where we've got the 2 years of reports, and we've got this year and next year's budget based on this year's actual. So this is the easy method of providing a budget based on historical. Alternative methods are zero-based budgeting or metric-based budgeting, each of which we've seen that we support any of those figures. So that's now created. And if we come back up here, you'll see the second year. And we'll just look at it the levy side. We put it up 5% from 10,000 to 10,500. All right, so let's move into reporting. So system record calculation, that is calculating every record. So any change in one field will re-impact on every value in the system. So now, reporting menu. We'll start with the forecast budget. We haven't got to what if there. Let's just do show all, which is an easy one-click touch to show all 4 reports so that you can then look at them side by side or as you go. So we're starting with profit and loss. Right, levy, accommodation, revenue, COGS, gross profit, memos, number of rooms and percentage. Remember, I ticked those to be shown. We've got a bunch of stuff in our grounds. We've got our salaries. We've got our total overheads. We've got our depreciation coming in the depreciation section. I can change that quite easily to have the depreciation for plant show up in the direct cost section. Now, because I've made a change, we need to do a recalc because any change can impact on those figures. Though this one won't actually impact on the calculations, it will impact on where that data shows. So we'll just rerun the show all. But you can get the speed and efficiency of what this is doing to be able to do this so quickly and simply to change. So now we've got our depreciation plant showing up here. We've got our depreciation for the other stuff showing down here. We've got our operating profit. We've got our EBITDA. We've got our overdraft or finance costs, and we've got our net profit, tax, dividend accrual, etc. So that's easy. 2 years. So let's see 2 years side by side. There they are, 120, 126. Remember, 5% increase. I want to copy that export it to the clipboard, open up Excel, click on a sheet, paste. Now you'll notice the description goes out there. That's been used by clients to record changes and therefore notate what was changed, but don't worry about that too much. Let's deal with the cash flow. So on the cash flow basis, because I ran set all, this is the all banks combined figures as opposed to individually. So if I run the cash flow report here, I'll get an option to do that. Trade debtors, hot link revenue, because they are separately invoiced, they're showing separately, GST refund, loan capital coming in, trade creditors, salaries, plant purchase, GST. We have done nothing to GST to get this to work other than to use it on the records. Income tax, we set that. Dividend, we set that. PAYE. We automatically split the PAYE from the net wages. So salaries are shown here, and we'll see the monthly, two pays, 3 pays in July, and the PAYE for the next August. So now what we've given is our cash bank position. So we started with 120 in funds, spent 289, overdrawn into funds. And we processed the net cash flow, all those figures. Balance sheet. So the obvious balance sheet presentation, we get our opening balance sheet, we get our 1 year and 2 years, we've got all of our balance sheet items listed, current assets, creditors due within 1 year, net current assets, term liabilities, capital. Now, occasionally, or fundamentally, if it gets out of balance, and it can get out of balance mainly through this sort of thing. If I just change this to 1.6 there and I go, okay, I've now changed my opening balance. I say no, because I haven't dealt with it. I come back to my reports and I will have an out of balance. So I'm demonstrating to you that it does happen, but we expect it to be sorted, resolved, because it is a double entry system. And so most often than not, it's caused by not doing the entries quite correctly, especially in actuals. But now you'll see here, down the bottom here, I've got an out of balance figure and it's displayed. So we can actually go back and check it because integrity is paramount to what we're trying to do. And then finally, the funds flow report. Now, I've just tweaked that. The funds flow is profit, less accruals, provisions, coming back to a cash profit, changes in debtors, creditors, i.e. changes in working capital, investing activities, plant, loans, finances, total cash inflow. And you see here at the end of the year, $48,000 negative. If I just rerun the cash flow for all, boom, very simple. So you can see here, you can choose which bank account to do. That runs, it finishes, the 48,675 will be showing up as the figure that the net cash flow by bank accounts moved. We know now that our cash flow tracking is reconciled to our funds flow. So the funds flow shows every movement except for the bank account, and the cash flow report shows the bank account movements. Okay, so far good. So we now have our 2-year forecast. So one other really good feature in the standard reporting is what we call one touch. Now the idea of one touch reporting is the ability to select all the, I'll leave the fixed assets in, add in what we call a template, like the one touch template, which is a spreadsheet with a cover page, an index, run the reports. Now what this process does is it runs all of the reports out into Excel. So yes, we're trying to put Excel out of doing budgeting, but we like using it for reporting because it actually is a great reporting tool. And it's the ability to now take that data, put it in here, turn it into graphics, visuals, or whatever is very, very simple. So we provided a function called One Touch. We also have a capability of writing reports, very sophisticated dashboards in Excel, drawing data from Forecast 5. If you think about it, and I'm going to show you, to an extent, I'm going to show you actuals. If you think about it, you have the actuals as well as the rolling forecast in Forecast 5. Then using Forecast 5 to present your financial management reports or customer reports is logical because we're containing the entire data set of here's what you did, here's what you're doing, and here's what you're going to do, making it nice and easy, especially with variance reports. So this is just about finished, I think. Cash flow, funds flow, fixed assets, that sort of stuff. Didn't I leave these something? There's also a range of supporting schedules, employee loans, GST, assumptions, reports, stats, and ratios that can be produced to support and take it out. Now, obviously, everything goes out into this one-touch reporting. So there's my fixed asset schedule. Now it's saying, yes, I will look at it. Now, this is now in Excel when it opens. Right. So there's my cover page. There's my contents, disclaimer, company profile. They are just standard sitting in the template. You'll see that it's been named April 23. It's been saved to my documents. Here's our P&L, balance sheet. The real power is you go to print preview, you select the entire workbook, and I now have a 27-page report to provide to our customers, print it to PDF, save it to PDF and email it to them. And you'll see that we have formatted each year to fit on the one page, horizontally, vertically at least, sorry, and a summary sheet and do that. So you can run this report all the way down through to here, funds flow. The last couple of pages will be fixed assets, right? Or last page will be the 2 fixed asset schedules. So very useful, very effective, right? So let's not come back at that. Okay, so 40 minutes, we've got to this point. Now I'd like to bring in the actuals process. So what I'm going to do is just to make sure that we've got something to make some variances at. So we'll go our body corporate levy. We'll leave it at $10,000 and we'll turn on actuals. No, I won't. I'm sorry. I'm going to stop there first. I'm going to do what if. So scenario planning, then we'll go to actuals. So scenario planning is what if multiplier. What if my sales go up 20%? So at this level, this will update all records. So we're going to focus on the 10,000 because it's easier. So we'll go to the body corporate levy and we'll say individually, everything's going up. Sorry, group-wise, everything's going up 20%, but we also want this to go up another 10%. So that gives us a total what if of 132. So we show what if, we've got 13,200. We'll unshow the what if. We'll hop over to reports, and then we can run the what if reports. And that is the complete set of reports on these what if values. So the profit and loss, the cash flow, the bundle. So if we select here, what if, profit and loss, cash flow, select all banks. I will just let that run. Come on. That always wants to be difficult. So you might see that is just simply we're working hard and Windows is a little tickle to see whether you're going, we're ignoring it. So let's go back to the profit and loss what if. We can see our 13,200 running across, and then the impact that would have all the way down because we only increase sales from that. And then if we go back and we can run the forecast report, profit and loss, and we get the original budget. Okay, so there's the 10,207. So simple planning on the profit and loss records. Okay, so options with that, I can save it as the budget. So we can overwrite the 13,200, we'll overwrite the 10,000. I can save it as a new forecast, or I can reset it to originals, which is what I'll do. Just takes the what if, and these go back to 1. Okay, now we'll do actuals. So starting actuals, click the start button actuals. It brings up the enter actuals. Now, right at the start, I connected to Xero. We're still connected. I will just reset this. Shows more clearly. And I will say April 23 for April 23 import. And we've already done this for the balance sheet, so you know it works that part. But I will just do the same thing here. Now, What we're now doing is I'm going to save, yes, we're not going to worry about the auto balance. We'll just ignore that. What happens, you can see that April 23 is now shown in bold. So that tells us that the April 23 is the current actual month. And that's how we distinguish it. What we're also capable of now is reforecasting. So creating a rolling forecast. After the first month, you can now reforecast May onwards right through the rest of the year, or either doing it on a rolling continual basis or doing it quarterly or 6 monthly, whichever fits for what you're trying to achieve, what suits you. So in the last phases of this, we're just waiting for this to post because this is actually now updating 24 months times all these records, all the calculations go in there because the what if record, the actuals now impact on the projected situation for our rolling records. We'll just give that a second or three to finish. Okay. All right, so we haven't had any questions yet. So I'm either doing a really good job or nobody's taking any notice, or I've covered everything you want to do. So let's see. I'm happy to see if something comes to mind, but we'll come forward. While that's doing that, I might just run another copy up because I know how to do this and I can do, and we don't have to wait for that for a bit longer. And I'll just go in as user one, I think. No, I found out yesterday it's Jeff. And let's look at another forecast. So there's our April demo. You cannot hop into the same forecast. In category in Xero. Okay. Let me that. Right. I should not have done that. Let's come back here. So Xero here, and that is an example of tracking categories in use. The record shows up on that, but I've cleared them out. So let me just now go back. This one. Right, so we've now got our figures coming through here, and I can reforecast. So let's say we're going to go 12,500 a month, right? So now I've got a actual and a reforecast, and now let's look at the reporting capabilities around this. So we have obviously the original budget, we have the actuals and therefore variance reports, and we have a rolling budget, so therefore a rolling report sequence. So we'll just come into those, and that calculation is because I've changed any of these values here going forward. Remember, we started at $10,000 for the original budget. We've got 18,000 for actuals, and we just need these reports to come. Right, so let's have a look at the rolling budget, profit and loss, cash flow. Just the first two. Right. So what this gives us is a mix of the actual and the projected. So you'll see in a second. So coming back to the profit and loss. Right, so here's our actual, and then there's our projected, the same for the cash flow rolling. So that's that part. Now, running the variance reports, I can only do it in the first month against the original budget because there was no revised budget. So the profit and loss will give us actual, budget, variance. Year to date, actual, budget, variance, right? Adds percentages. And the cash flow does exactly the same thing. And equally the balance sheet and the funds flow. So you can now analyze what's going right or wrong or what can be done. So you have here, actually we banked 21,000. We had no budget for banking, and therefore our variance on cash flow is positive. So we've got that. We've got a $16,000 difference in here, and we can see down here is our variance on cash flow. Coming back, going to enter actuals. Now we get to the speed. Month 2, May 23, select May 23, import. Yes. Now, in seconds, it's still importing, so we're just waiting for that to come through. So that'll change back to, okay. Oh. Let me just go back into this other one. Right. So I think that's because I've got both of these sessions open at the same time. It wouldn't make it easy for it. Anyhow, so the actual process allows us to continue to bring in that. So let's just go through a couple of these questions. The tracking category report. Under the reports, profit and loss by tracking category, you then can select each or any one of those tracking categories. So those are the project code and external code. And irrespective of that, they could be job code or cost center code or whatever. It's just that we use those two fields to hold that. All right. Allocation of costs between one and another, that's the formulas. So if you want to total up a cost down here, so if I go into a memo, add a record, we'll just say cost, not cost units, we'll go for costs. Purchase invoices, we'll select a couple of these, we'll get some numbers. Right. So we get some costs here. Costs. Right. Now, at any point in here, I can go up to any record I want, and I can do this as a percentage of memo. Right. So that can reallocate my costs 5%. If you are trying to do intercompany recharges, then what we actually tend to do is we set up a section called intercompany recoveries. We use a hot link to these records. We bring back the total expenses and allocate it. So there's a whole paper on those for doing that. So we handled that part. Can you import wages and fixed assets? Yes. So there's wages details. And any of this data that you've seen here, if I come back to my Excel spreadsheet, if I open up my demo one, which I haven't done today. Right, so my record list is formatted. We've got land buildings, motor vehicles, cars. Let's insert a bike. So we're on the roll. I select these records, copy. I come back into Forecast 5. And over here in the utilities, we have got record list import and record details. I click record list and that will import that. So we'll just let that run for a few seconds. It's going there. Not quite. Forecasting linked to fixed assets. Yes, when we imported the records, we imported records that designated as fixed assets. What we then did is linked and connected the accumulated depreciation, because in Forecast 5, they are one record, and therefore the accumulated depreciation is a second GL code. And we map that, and then we map the depreciation record, the same as we do with the bank interest record. So for finance interest, we have a P&L interest record to use and map that. Now, MYOB advanced, can we write them back? Not in that essence. What we do is we have an export from the main menu. Let me just try and get us one of these things back. Just a second, just open up, clear out some of this stuff. So whilst that's running, we can run up another one. It's importing the record list from clipboard out of the Excel. So all of this stuff comes up very easy. So we'll just go in here as admin. Okay. Now, from here, export forecast data, you select April demo, the original budget or the actuals, and we export it either as a GL export or a Spotlight or a Fathom format if you want to do graphical reporting. We say, okay, that will outline the records as follows. Record name, GL code, month 1 to 180. We support 15 years. You can tailor that in minutes and then import it into any other budgeting system. So Forecast 5 principally does not write back to any financials. We only read it, and that takes us out of any queries. Most financials, even Xero has it, even though it's only a profit and loss, and you know Xero only calls it a forecast. We do a budget. We do the full budget, balance sheet, the work. So just some extra ways out of that. So we'll come back over here. And I've now imported these records, and I was showing you that we imported the bike. There it is there. When we go to the opening balance sheet, that would come in as the value. So that sort of comes there. Okay, so just finishing up the last little leg of this. Feature of consolidation. We have the ability to consolidate multiple forecasts. And if we pick on branch A and B, we need to match a few rules. The start date is July 23. Start date of the consolidation needs to be July 23. Currency can be any one of those, or add a currency. And we can consolidate by name or GL code. And then we can select branch A, branch B, A and B, back to front. You can click here, we can see they're 1 year and they're Australian dollars, and that's an Aussie dollar. So we're going to convert it. It's going to have a little query and say to you, designate the exchange rate AUD to NZD. So you can consolidate multiple currencies. You can consolidate like for like, budget, actuals, whatever, all of those records. So you can see here we've imported this. Branch A and branch B is shown there. So I'll just show you the last of that features. It's just sourcing the currency record to have me bring up and define the exchange rates. And once there. So the Australian dollar is worth 0.9. So it'll be happy now. Okay, so now we can look at the records. So the consolidation adds all the records, and in this case by name together, and gives us a total. And we record and report the individual contributions. 225, I'm looking at that, and 255 gives us a total of 533. All of the reporting, everything else is identical. So you can import actuals and do variance reports at a consolidated level. You can consolidate consolidations. There is no limit to that uplift or anything like that, just simply how fast your computer is. I have got 150 I have got 150 forecasts consolidated into divisions, departments, group, entity. For first run took 45 minutes, reopening takes 15 minutes. So that's a pretty good result when you think about the number, and these are not small, these are 400 records each by 6 or 7 years. That's a lot of data to add up, and it bounces. So all of the reporting like that can be done and simply put into there. I should have finished by now this one. So this export was the group level, as I said, the forecast name, the record name, the GL code, the budget type, and then the data for 150 years or however many years we have, right? Now, to get that in a format to import it, we don't care about those two things. We don't care about those or that. The only thing you've got to care about now is it a positive or a negative sign for revenue? All right. But that's now can be saved, and you can then import it, and there's the balance sheet, which I will probably underwrite to you. None of your financial systems have a balance sheet budget imported. Might do, but I don't think I recollect any of them. I've seen a lot of ERPs. Anyhow, so we can get that back. If you want to do it, we could probably look at developing it. It's not difficult. Right, so our consolidation now, profit and loss. Okay, and so that's going to give me that group position across all of that budgeting and everything else like that. So yeah, we've now got a group position. Okay, so coming to the last legs, I'd just like to show you what you do after you've done all of this, because you've now got lots of spare time. And we open up what we call our dashboards. And this is where we customize and custom build. If you are skilled in Power BI, you can do this in Power BI. Good luck. We tried, and we ended up in Excel on the basis that then that can go to Power BI. But these are the ability to custom write reports, P&L report with slices, with years, that sort of thing here. Variance reports, it's just dashboarding. It's just really what do you want? Expense, year total. That is what I call the dashboard. And then the other one we did charts, which are not much too much different other than to say, one I think we did one way, and the other one was a simple, here's my snapshot in one forecast, right? So select the template, select the year, August, July, whatever, and as I'm really good at, make it stop working. So whatever I did, I don't know. I'll go back to some. So obviously this works from what we call data and using pivot tables and source data, which is extracts of our data into the right format. We tend to build them there. So those are two of the more advanced things where you basically build your exact need and get it so you want it. So even if that now is the management report together with our one touch. Okay, so with that, come to the end of the tour of Forecast 5. We have a range of other bits and pieces. I'm sure that we can address questions. You'll look here, some of the types of things we've got. Subdivision model. You buy the land, you spend a whole lot of money, and then you start to sell it, and you have deposits on sections. You realize school roles, kindergarten, student roles, wine costing. So standard costing records for manufacturing. We support all of that. Sales demo, it sort of ranges there, and not for profits. We have no problem with any of the types of businesses or entities that you have run across. Yeah. We also have some nice things like copy forecast, copy no values, so we get a template, refresh all hot links just to make it all go, and for support work, export and import forecasts. Okay, so with that, bang on the hour. Thank you very much for your time. If there are any more questions, I'll give you a few seconds to put something in. But we have given you, hopefully you can see the power of what we have here. It allows the budgeting process to become very simple and easy. It's clear. I am not looking at a spreadsheet that goes if this, then that, and then up that, and what if, and if, why, how, and trying to work out what all the links mean. And I have looked at a lot of them over the years as I've converted people off there. And you then sit there wondering why your values don't balance until you find out their spreadsheet doesn't balance. But it's not always the case, but it's just you sit there scratching some of these things. But yeah, thank you very much.